The only issue that is not manageable is the interest payment relative to GDP. And this whole, obsession we all have with inflation in labor markets is sort of meaningless. It doesn't really matter anymore because interest rates need to be reduced regardless.
This is Kaiser Johnson, and these are the Miles Franklin Weekly Specials for August 19th through August 26th, 2024, while supplies last. First, we feature the famous 1-ounce gold Krugerrand at just $60 over spot. Next, we have the favorite bullion coin of Europe, backdated silver Philharmonics at just $3.10 over spot. And finally, we have 1-ounce platinum Canadian maples at only $80 over spot, one of the lowest premiums on platinum we've seen in a long time. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Tavi Costa from Crescat Capital. Tavi, thank you so much for joining us today.
Thanks for having me. Looking forward to this.
Well, it's great to have you today. Now, you wrote an article on Crescat.net, and it's all the articles you write come with a whole lot of amazing charts that really just blow my mind sometimes, of really detailing what is going on in the economy, precious metals, the financial system, and this time U.S. debt and the U.S. dollar. One of the things that really was surprising, and not maybe surprising to me, but you always see those charts of the U.S. debt and maybe debt to GDP. And right now we're at an all-time high. But if you look at interest payments to GDP, U.S. interest payments to GDP, we're just completely in a new territory. We've never been in this scenario before. So what does this mean maybe for the U.S. financial system and the U.S. dollar going forward?
Yeah, I mean, there's a lot to unpack there. I think that shows that the U.S. cannot afford a restrictive monetary policy any longer. And not only that is a completely inconsistency of monetary policy relative to the magnitude of the debt. And an unpopular view is that, yes, the problem with leverage in the U.S. is extremely manageable. The only issue that is not manageable is the interest payment relative to GDP, in which is currently at levels that can create a lot of problems already. And so it is likely to be, making the Fed job extremely difficult moving forward. And this whole, obsession we all have with inflation in labor markets is sort of meaningless. It doesn't really matter anymore because interest rates need to be reduced regardless. And so I can even point to a position in the markets that we may see where interest rates may be reduced by the Federal Reserve. And at the same time, we may see actually inflation reaccelerating and the Fed being forced to ignore that. And it's not like they're being ignored. I think that can be rephrased. Maybe that's the part of the plan. I think a lot of people would agree with that. Inflating our way out of that problem is one of the ways out of this situation. But that research was remarkable because a lot of people think that other central banks are in a very difficult position, and they are, but they have been managing their service debt ratio much better than the U.S. And so as the U.S. starts to sort of go back to normal, or in other words, normalize its monetary policy relative to where the debt problem really is, I believe that that's likely to have major impacts in FX. And to add to that point, when you think about it, I've always been a very bullish on hard assets. I've always come out in your show and talked about hard assets, commodities, gold, but I've never talked about being bullish on fiat currencies relative to the dollar. And that differential of interest rate policy relative to where GDP is and the cost to service the debt is just so out of whack with the rest of the world that, I do think that the policy, the risk for the U.S. moving more rather than less relative to other central banks is significant. And that's going to have a very, I think it's going to have a meaningful impact in FX and also the dollar itself. And pay attention to days when NASDAQ is declining and the dollar is supposed to be rallying, but it's not rallying. And so some investors, really savvy investors, are starting to pick that up. And, I do think that this is going to become extremely meaningful in the following 1 to 2 years. I mean, this is already a big problem. And even in Jackson Hole, I think it's likely to be a big discussion across most policymakers.
When it comes to, I guess, the impact on what the Fed is going to be doing moving forward here, you said that the Fed really has to make substantial rate cuts in the coming year. And when it comes to how this is going to impact the US dollar, the Fed has a dual mandate of stable prices and maximum employment, right? That's the official two goals of the US Federal Reserve. But if they're going to be decreasing interest rates and the value of the dollar has to fall, it seems like what you're saying, then how can that be really, how is the Fed going to maintain stable prices? It seems like we're just going to see a lot of inflation going forward.
Well, these mandates, they are useful or used in discussions when the imbalances are not large enough that constrain you to focus on those things. But the imbalance we have is so significant that we don't have a choice at this point. We have to focus on allowing the government to service its debt and take that burden off. And how do you take that burden off? So if you think about the maturity profile of the debt in the US, the federal debt maturity, average maturity, or just think about that 1/3 of the federal debt would be maturing in the next 12 months. That means a lot of these debt, we've seen a huge amount of T-bills being issued recently. Those are very short-term bonds. And if you think about it, or not bonds, but treasury securities, if you think about that, the Fed interest rate policy has a direct impact, almost direct impact on how much we're going to be paying in interest payments moving forward. So it's their job, essentially. Their mandate is being responsible for the government to pay its bills. And so I think that's going to change the whole game. And if we think about as well what happened in prior eras, because I like to look at Japan, I like to look at all these countries, but they're not as relevant because they're not the reserve currency. They don't have the same capabilities as a country that has the reserve currency status does. In fact, I think the main reason why we've had so much growth in the US versus other countries is not the exceptionalism from the economic side, but really from the fiscal side. It's being able to be, fiscally indisciplinary for longer than other economies. And, we're talking average of 8+% every year of fiscal spending. Of course, you're going to be generating growth versus other economies. And those are very consumer-led spendings. They're not infrastructure spendings. They're much more consumer-led. So going back to the UK, or I should say the British Empire in the early 1900s, when did it really start to bother them was when interest rate payments relative to GDP reached between 4 to 6%. That was the turning point in which they had to accomplish a few things to reduce that burden on the debt. So what did they do? Number one, they restructured the debt. Well, that's a very radical shift. It would be basically us either changing entirely the profile of the debt, the maturity. And what they did is they basically elongated those maturities massively and created a sinking fund to make investors more comfortable with those restructurings that were following up. But that, you can see debt jubilee. I think those radical changes, they come later. They're not the first option. The first option is something called yield curve control, yield curve suppression. I don't know what you call, but any sort of thing that allows you to suppress the interest payment and allow you to actually manage the debt, because the debt problem can go up to 200, 250%. I mean, we're not there yet. We could increase the debt problem. It's just the interest payment needs to be readjusted. Japan is way higher than that. The British Empire was over 200% of debt to GDP. And they were fine as long as they keep that interest payment lower. Now, that obviously starts to have impact on investors flocking into other things rather than the dollar. So you start seeing other currencies being bid up. You start seeing especially hard assets doing very well. And to me, this is the main reason why if the US cannot afford having a restrictive policy, how can I have a deflationary view in this environment? It's really difficult for me to come up with that opinion because it all predicates on the fact that they are going to be forced, in my view, to suppress rates. And therefore, it's likely to create massive inflows towards hard assets overall. So that is the reason why this long-term thesis to me not only remains intact, but it's just gaining more and more momentum. And I feel very confident that this is likely to be one of the best opportunities, at least in my career.
Now, when it comes to the stock market, you also have mentioned that it's very overvalued right now. If you look at the major indices, we're at all-time highs pretty much in all of them. Now, if we see this outflow of investment from the US dollar, do you also anticipate an outflow of investment from the US? And how do you see that impacting equities here?
Well, you see, if you study gold cycles, you will also understand that they unleash with other trends that also happen in tandem. Weakness of the dollar is one of them that usually tends to happen. It doesn't necessarily need to be the case, but it's very likely to be the case. Emerging markets tend to do better than US markets. Commodities tend to do very well. Natural resource industries tend to do very well. And so it wouldn't surprise me at all if all these things work out. I'm paying close attention. I love the miners and I also love emerging markets because I think that that's the differential of valuation of a business in the US versus emerging markets is reasonable to have a premium in the US. Well, there are things in the US that work much more efficiently. We have a better labor market versus, let's say, Brazil and other things. But at the same time, when that disparity becomes so extreme like we're seeing today, that becomes unreasonable, in my opinion. And every few decades, we have these shifts of flows and leadership. Rest of the world leads. And then, early 2000s, if you bought Brazilian equity markets, plain vanilla buying Ibovespa, the index at the very early stages of the early 2000s, that index alone went up about 18-fold. So, they do provide some insane amounts of opportunities in the right environment. And what is the right environment? Usually that's aligned with commodities doing very well. And you have all these signs that are, linked. For instance, natural resources being so constrained on capital. If you look at capital spending of these industries, particularly mining, these things have been extremely constrained for some time now. And usually that has an impact on long-term supply of those metals. And so, it also creates a long-term thesis on the demand side for most of those commodities too. Energy space is the same way and all sorts of things. And so, I think this is all linked in a certain way. And as investors, we need to, sort of find these buckets of opportunities. And they're not going to happen all at once, but during the course of a full decade, it would surprise me if they all don't work. I think they're all going to be holding hands at some point.
Now, when it comes to the ratio of the stock market to gold, you've reported on the Dow gold ratio and how it seems like in the past we've seen a lot more volatility. And in recent years, it's been more stable than usual. And we'll put the chart on the screen here. But why do you think it's been more stable? And do you see that changing soon with gold significantly outperforming the stock market?
I do. In fact, if you look at the gold to NASDAQ ratio in the early 2000s, I think it went up about 13-fold as well, which I think today would be unthinkable. Now, if I tell you that the gold to NASDAQ ratio would go up 13 times in the next call a decade, I don't think a lot of people would agree with me here. And so, and the reasons for that again is because something got really frothy valuation wise, and the deflation environment of those valuations, certainly was a huge factor. And the second factor was that gold outperformed extremely well too. And so it's a combination of things. And I think the main reasons for this is, I had a good chart of the CAPE ratio, which I like the CAPE ratio, the cyclically adjusted PE ratio, because it gives you a good perspective of history. And we often do in, hindsight analysis. In other words, we look back in history and we say, oh, well, obviously 1929 was a bubble. Obviously the tech bubble was a bubble. But then we looked at valuations extremely comparable with those peak periods in markets. And we say, nope, it's not a bubble today. But then in 5 years from now, we'll look back and say that was a bubble. I mean, that just seems a little bit evident in terms of the signs that things are extremely expensive right now. And so some people may say, well, but there's still room to go from where we are to the tech bubble levels, the very peak of the tech bubble. Yes, but we don't invest for that room. We invest for large rooms. I mean, at least I do. I looked for the risk reward, and I assess that risk reward profile for each investment I make and each idea I have, and I invest accordingly. But that just seems to me that the risk outweighs the reward in a significant way. And I'm not sure it's really, a relevant use of my time and capital to be, trying to, find the next AI company when there's so many resource businesses that have been stagnant that may see real secular growth, and those multiples are just not reflecting that just yet.
Now, speaking of outperformance, right, and the risk reward ratio, when we do look at miners and also silver, those can outperform in the long run compared to gold. And I know you've created a couple charts here I can share on the screen, the miners versus gold ratio. And in this recent run up over the last, a year or so in gold, we really haven't seen the same kind of performance in miners. So those seem to be undervalued at the moment. And then also, as we look at silver, the ratio is still significantly high, but you've noticed that this 13-year trend line support for the gold silver ratio was recently broken. So can you touch on those two, the opportunities you see in miners and also silver compared to gold right now?
Yeah, I get called a boomer all the time, although I'm a millennial, and which is funny, but because I love gold, and it's not that I just love gold. I just see that as an indication of other potential trends that could be unleashed because of the gold price. And I find it, and I think there are a few scenarios, but I find it those scenarios are significantly smaller than the amount of chances we have here of entering a gold secular bull market. And I have to wear that hat for the next 5 to 10 years and extrapolate that as if that's the case, then what happens? And silver has to come to mind. I think that owning a very significant silver miner today, which is extremely difficult, is going to be a very interesting investment for the following years. But that's my opinion. And the reason for that is because you want to find leverage to even silver prices that seem to have massive leverage to gold itself. And so I've been really focused on that. I mean, we did an acquisition of the 7th largest silver mine in the world recently. You don't do these things in a very bullish environment for silver. You do these things when things are really, depressed, which was the case not too long ago. And so, but the environment still is that way. We have gold prices going up and people still hitting in that thesis saying, well, but the miners won't work. And I don't know who's supporting these views historically, because they're not, throughout history, we don't see that. And so I'm not going to trust the new guy. There's always a new guy in markets that want to, claim the fame of knowing of everything about I put all my faith on history. I do a lot of analytical work and look at back in history and historical trends and correlations and long-term ideas that worked in the past. And the truth is that there's nothing similar to what we have today, meaning there's nothing equal. There's things that are similar. And so it is in a way unique. But I think it's unique from the standpoint of being more extreme than prior times, which means it makes me more bullish, not less, in the things that I believe, such as gold, emerging markets, miners, energy, agricultural commodities, you name it. FX of other fiat currencies versus the dollar. So to me, yeah, I think the dominoes are starting to fall. And it started with the gold and energy, but there's a lot more to go here. And so, like I said, they're not going to happen all at once. But once they will probably be somewhat linked to each other, as we tend to see throughout the course of a long-term period of time. But a lot of times we get caught up in these, 1 to 2 month periods, and gold went up and emerging markets didn't. So, this thesis is not right, and it's not true at all. These things, they take time to develop, and so if something hasn't worked yet, it actually gives me more conviction that I should act on it. And so, yeah, look, I've done a lot of work on this, and I could be wrong like anybody else. But conviction is a big part of this because we need to have that in order to act accordingly and add to your positions when you have those shakeout moments. And we will have plenty of those in the next 5 to 10 years. Gold is not going to go up in a straight line. Sorry to break that news to most of you, but that's just not going to be the case. And so the miners, they're going to go through a volatile period. But do I think the share prices and gold prices will be higher 10 years from now? Yeah, I believe so. And so if that's the case, some of these opportunities look extremely asymmetric.
And kind of taking a step back then, looking at the macro environment that we're in, we talked about at the beginning, the inflationary environment that we could continue to see in the future. Now, one last topic I did want to discuss is inflation expectations, right? You have said that those are probably bottoming. So can you give us maybe and wrap up kind of a macro view of where we're headed for price or inflation expectations going forward here?
I think we're sort of in a turning point in markets that we're going to get into a place that it's going to get extremely interesting. And a lot of people that use the word interesting use that word with the lack of conviction and lack of actual views in markets. And I don't come from that place at all. I think what's happening right now, if you analyze break-even rates, which are basically your CPI estimates by the market. I know some people hate CPI, but that's from a macro standpoint, we all have to pay very close attention to that because that has an impact on policy. And what's happening right now is that most of the charts in different durations, if you look at 5-year, 10-year, 30-year, which the longer you go, or especially the 10-year, have a little better liquidity, and so you can have a better chance of understanding that market better and having a better signal. And you see there is that, from a truly historical perspective, we broke out. We broke out from a resistance. This is coming out of the pandemic. And all the way back to 2022, 2021, we've been consolidating on this. And a lot of people have lost faith in this inflation expectation being in a consolidating mode, and they think that we're going to go back to a 2% inflation environment. It's not my view at all. And when I look at those charts, technically speaking, they look like they're forming a channel. So they've been in this channel going sideways, and they're right at the bottom of that channel. And everyone's concerned about recession, and so am I. And the Fed is trying to take the card of labor markets, revisions, all these issues going, all the cracks going on labor markets, say, no, we're going to cut rates because labor markets are clearly signaling, weakness, and we need to be less restrictive. That's fine. But the issue is what happens if that channel is right? We actually start seeing inflation expectations rise. Take a look at oil prices. They have not been on the news for a long time. And oil prices are not like that. They usually, well, they are kind of like that. They stay out of the news for a bit. They don't be, they kind of become ignored on the narrative side of markets for a bit, and then they come back. It wouldn't surprise me at all if we see oil prices coming back. And I think that's extremely contrarian view because everyone and their mother think that because of politics, oil will never rise during an election year because Biden has full control of this, and then some other people say, well, the probability of Trump coming in, and then we're probably going to see actual increasing production, the supply is going to surge, and blah blah blah. Look, my friends, if there is no capex, there is no production. It takes time to go from capex to production. And if you look at the capex, it just hasn't moved up yet. It's just so low. And so, in my view, we can get into an environment where production may increase, and actually, we may see oil prices staying higher and actually reaccelerating to the upside, maybe for geopolitical reasons and other problems. And that's like the kind of the perfect storm for an energy business. So I'm actually extremely bullish on energy businesses right now. I think that they've been consolidating for some time. I think they're likely to break out significantly. And if we see that, if we see inflation reaccelerating and the Fed being forced to ignore, showing their cards and saying, look, we're going to choose to ignore inflation because we got to focus on labor markets. But really, the truth is we got to focus on interest payments. That changes the whole environment. I don't think hard assets would be trading where they are if we see those cards being shown. And I think that we're very close to something like that. Wouldn't shock me at all if in 2 to 3 months, inflation comes back, roaring back, and which is extremely entrenched, and the Fed is in that position. And look, the market loves doing things that everybody disagrees with. Is there anything more contrarian than thinking that the Fed will cut rates and inflation may reaccelerate as the Fed cut rates and puts them in a very difficult position? I don't think, just looking at markets right now, none of that is being priced in at all. And so I definitely think that that's a very strong possibility. And I think we'll play into the weakness of the dollar too, in a very significant way.
Well, Tavi, if people are interested in learning more of your work, they can go to Crescat.net and also follow you on Twitter. We'll put links in the description to that. Any last thoughts before we let you go?
No, I don't think there's, major last thoughts outside of one more thing potentially, which is related to emerging markets and the opportunity there as well. I think I spoke about hard assets and all that, but emerging markets are also in an interesting setup because if all these things are correct, then and the Fed has to readjust their policy according to the rest of the world. And I'm saying this in a not in an absolute basis because that's not the way you should be looking at this. It's on a relative basis. Is how much does the Fed has to adjust its policy versus, whoever it is. And thinking with that hat, it certainly gives me a sense that we're getting close. We had a pullback in a lot of emerging market assets recently, and I love them. I actually think that they offer some of the best growth opportunities for the next 3 to 5 years. And so, to me, those are kind of window of opportunities that I want to take advantage of, and I think that they are, I think they're in a very good setup currently, in my opinion, to perform very well in the near term.
Fantastic. Well, again, it's Crescat.net. And if any of our viewers are interested in any of the other interviews we do and all the interviews with you, they can go to libertyandfinance.com, subscribe there. Can you tell us what they'll find at Crescat.net?
You'll find definitely in-depth letters about the macroeconomy. they will find information about our products, the hedge funds that we manage. And we also do a YouTube channel every Friday, or a live presentation in our YouTube channel where we discuss the macro environment and our thesis on some certain geologic views on companies that we own in the portfolio. We're taking an activist approach in the mining space. And so you can probably see a lot of that information there as well.
Fantastic. Tavi, thank you so much for your time, and God bless.
It's been my pleasure. Thank you.
This is Kaiser Johnson, and these are the Miles Franklin Weekly Specials for August 19th through August 26th, 2024, while supplies last. First, we feature the famous 1-ounce gold Krugerrand at just $60 over spot. Next, we have the favorite bullion coin of Europe, backdated silver Philharmonics at just $3.10 over spot. And finally, we have 1-ounce platinum Canadian maples at only $80 over spot, one of the lowest premiums on platinum we've seen in a long time. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.